$345 trillion. That's the amount of debt the world is currently drowning in. It's a number so vast, so astronomical, that it's almost meaningless. If you started counting to a trillion, one number every second, it would take you over 31,000 years. Now multiply that by 345, it's a figure that breaks our brains. But here's the thing. The sheer size of the debt is uneven the most interesting part of the story. The real mind-bending question is, who exactly does the world owe all this money to? When we think of debt, we usually picture one country owing another. Like the US owes China, or Greece owes Germany. And yes, that's part of it. But it's only a tiny slice of a much bigger, much stranger pie. The reality is, global debt is a tangled web, and if you follow the threads, you'll find they lead to some very surprising places. In fact, you might discover that you are part of this system, both as a borrower and a lender, without even realizing it. So today, we're going to unravel this massive financial mystery. We're going to figure out who owns the world's $345 trillion IOU. First, let's break down who's actually doing all the borrowing. Global debt isn't one giant pile of money. It's split into three main categories: governments, corporations, and households. For a long time, governments were the undisputed kings of borrowing. They issue bonds to fund everything from roads and hospitals to military spending and social programs. Think of a government bond as a formal IOU. You give the government money today, and they promise to pay you back with interest in the future. But governments are no longer the biggest borrowers on the block. That title now belongs to corporations. Companies borrow for all sorts of reasons: to expand their business, to fund research and development, to survive a downturn, or even to buy back their own stock to boost its price. They issue corporate bonds, which are similar to government bonds but generally a bit riskier, or they take out massive loans directly from banks. And then there's us, households. Every time someone takes out a mortgage to buy a home, swipes a credit card, gets a car loan, or takes out a student loan, they're adding to the global household debt pile. Individually, these amounts might seem small compared to the billions borrowed by governments and corporations. But when you add up every mortgage, every credit card balance, and every personal loan on the planet, it becomes a colossal figure. Together, these three groups have pushed global debt to a level we've never seen before. It's now more than 3 times the size of the entire global economy. Let that sink in. For every dollar of economic value produced in the world, there are more than $3 of debt. That ratio alone should make you pause and ask, is this sustainable? But it also brings us back to our main question. If everyone is borrowing, who is doing all the lending? Alright, this is where it gets really interesting. Who holds all this debt? The answer isn't some shadowy cabal of global financiers sitting in a dark room. It's not a single entity or a rogue planet we owe money to. Most of the world's debt is held by a familiar cast of characters: banks, pension funds, insurance companies, central banks, and ordinary people. That's right. We, in a way, owe the debt to ourselves. Let's break it down. When you deposit money into your savings account, what do you think the bank does with it? It doesn't just sit in a vault. The bank lends that money out to households buying homes, to companies expanding their operations, and it buys government bonds. So, your savings are being used to fund someone else's debt. What about your retirement account? If you have a pension plan or a 401k, a large portion of that money is likely invested in bonds. Those are the very same government and corporate bonds we were just talking about. Your retirement security is literally built on the promise that these debts will be repaid. The same goes for insurance companies. They take the premiums you pay every month and invest them, often in safe, reliable bonds, to ensure they have the money to pay out claims later. So, you see the loop. A company borrows money by selling a bond. A pension fund, managing your retirement savings, buys that bond. The company owes money to the pension fund, which in turn owes that money to you in the future. It's a complex, interconnected system where the lines between borrower and lender are completely blurred. We are all entangled in this web. Now let's zoom in on the biggest players, governments and their central banks. When a government, like the United States, needs to borrow money, it issues treasury bonds. Who buys these bonds? A huge chunk is bought by domestic institutions right at home: American banks, investment funds, insurance companies, and pension funds. And, of course, the Federal Reserve, the U.S. Central Bank. In recent years, central banks around the world have become massive buyers of their own government's debt. During crises like the 2008 financial meltdown or the recent pandemic, central banks stepped in and bought trillions of dollars worth of government bonds. This action, known as quantitative easing, helps keep interest rates low and injects money into the economy. But it also creates a very strange situation. The government owes money to an institution that is essentially part of the government. The Treasury Department owes money to the Federal Reserve. It's like borrowing from your right pocket to pay your left pocket. This is a critical point. While we hear a lot about which foreign countries own U.S. debt, the reality is that foreign holders, like China and Japan, own only a portion of it. The vast majority of U.S. debt is held internally by American institutions and investors. This shows that the global debt story, isn't really about an international power struggle of who owes whom. It's more about our internal financial systems becoming completely dependent on a cycle of continuous borrowing and lending. So, why does this system just keep growing? Why don't we just stop borrowing and pay it all back? The simple, and perhaps uncomfortable, answer is that our modern economy is built on debt. Debt is the fuel that powers economic growth. It allows governments to invest in infrastructure like bridges and high-speed rail without having to raise taxes to impossible levels today. It allows companies to innovate and create jobs. It allows families to buy homes and build wealth. Without debt, our economic engine would sputter and slow down dramatically. It's a double-edged sword. Debt builds our world, but it also creates fragility, and that brings us to the real risk. The danger of all this debt isn't just its massive size. The real danger is the price of that debt, the interest rate. For years, interest rates were at historic lows. When money is cheap to borrow, a $3-100-40-5-trillion debt pile feels surprisingly manageable. Governments can easily afford the interest payments, companies can refinance their loans, and mortgage payments are affordable. But what happens when interest rates go up, as they have been recently? Suddenly, that debt becomes a very heavy burden. Governments have to spend a much larger portion of their budget just paying interest, leaving less money for schools, healthcare, and everything else. Companies with looming debt find it much more expensive to refinance, which can lead to cutbacks or even bankruptcy. And for households, rising rates mean higher mortgage payments and credit card bills, squeezing family budgets. This is why you hear economists and central bankers talk so obsessively about interest rates. They are the control knob on the global debt pressure cooker. Smart investors are paying very close attention to this, not because they think a global collapse is imminent, but because they understand that high debt levels reduce flexibility. When an economy is leveraged to the hilt, it has less capacity to respond to the next crisis. Whether it's a pandemic, a war, or a natural disaster, it makes the entire financial system more fragile, where a small shock can trigger a large and unpredictable chain reaction. So, is the world about to fall off a financial cliff? Not necessarily. High debt doesn't automatically mean disaster. Economies have managed high debt levels before, but it does mean the system has far less room for error. It's like walking a tightrope. You might be perfectly fine, but you have to be much more careful. A sudden gust of wind can have catastrophic consequences. So, what's the real takeaway here? The world does untow its $345 trillion to some cartoon villain or an alien race. It owes it to banks, to pension funds, to insurance companies, and ultimately, to itself. Global debt is not a ticking time bomb waiting to explode. It's more like a complex pressure system, and that system is only stable as long as it is managed with extreme care. And as long as everyone involved continues to believe in it, because that's what it all comes down to, confidence. The entire system is built on the belief that these IOUs will be honored, that governments will pay their bonds, that companies will repay their loans, and that you will pay your mortgage. Debt is what built our modern world, but it also fundamentally constrains it. And the moment that confidence breaks, when the debt stops being an abstract number on a screen and becomes a very real, very powerful, and very disruptive force. The question isn't who to blame for all this debt. The real question is, how long can we keep this delicate balancing act going? Thanks for watching. If you found this explanation helpful, don't forget to like this video and subscribe to the channel for more deep dives into the forces that shape our world. See you next time.